Uh, Nilesh Bhai, great having you. Let me first start off by understanding from you in terms of asset allocation in a market like this. You're obviously a believer that one should be a patient investor, one should be a composed investor. When there are corrections, you should reallocate towards equities. At this juncture, how you how do you split the bucket in terms of asset allocation right now?
So every month we publish our monthly market outlook, and we also share what allocation practices we are following in our own asset allocation fund. At this point of time, we are neutral weight to equity, neither bullish nor bearish. We will continue to increase allocation to equity if valuation becomes cheaper. On the fixed income side, we are again kind of marginal underweight, more focused on carry than on the duration at current level of yield. Some time back, we were long duration, but now with interest rates moving down, with oil prices coming down, we are focusing more on carry. On the precious metal, we are little bit overweight gold and little bit underweight silver, but overall precious metal allocation is still on the neutral side. This is the market where we are focused more on carry and moderate return rather than spectacular return.
Nilesh, hi, morning. Domestic flows have been strong. Again, in the month of June, you've seen 31,000 crores coming through SIPs, and that's holding the market there. But are we in a time consolidation because the market remains in a range bound as we speak? What could be the triggers that will push the market higher?
So essentially, Sajid Bhai, we are in now the tortoise part of the tortoise and hare race. Markets will continue to move ahead, albeit at a slower pace. The market returns can come in two forms. One is earnings growth, second is valuation re-rating. Valuation re-rating is unlikely to happen, and earnings growth is likely to be in high single digit to low double digit as inflation has come down. Investors will have to get adjusted to moderate return in the years to come.
Okay, slow and steady shall win the race. But Nilesh, hampering that race will always be these very volatile crude prices. How, as an investor, do you adjust to this new reality?
So Ayesha, one, we have accepted that dawn ko samajhna mushkil hi nahi, namumkin bhi hai.
Absolutely.
Nothing we can do about it. There's nothing we can do about it. So we'll have to basically, live with the volatility. We don't really change our view significantly when oil prices went up or when oil prices came down. This variable is outside of our control. Our focus is on investing in entrepreneurs, businesses, which can withstand this volatility and still deliver growth.
But tactically, Nilesh, I mean, or rather, not just tactically, but just, as a strategy, do you steer clear from oil sensitives, the segments which are bound to wane heavy when oil prices do shoot up?
So essentially in commodity, Ayesha, what we have learned is that you have to be a contra trader or contra investor. Whenever commodity cycle is at a higher level, earnings growth will be spectacular, P ratio will look very low, and that's probably the time to sell. On the other hand, when commodity prices are at bottom, companies will be in red, P ratio will look infinite, and that's the time to buy. So in commodity, we try to play as much contra as possible. Obviously, we don't know how to time it to the perfection, but this contra strategy has by and large worked for us in the commodity play. Oil is no different.
And how do you look at the IT play, Nilesh?
Sajid Bhai, this is where we are in confusion. One day we become bullish, one day we become bearish. But limited point here is that there will be winners in IT sector and there will be losers. There are some companies which are leveraging AI to empower their employee and making progress on enterprise AI side. They are working with clients to deliver cheaper, better, faster solution in AI integration. There are some companies which are slow in that. Every company is moving in that direction, but some are slow, some are fast, and the faster one are likely to emerge winner. Today, across our portfolio, we have invested in companies which we believe will be outperformer within the IT sector, but overall allocation to IT sector is kind of underweight at this point of time.
What about gold and silver, Nilesh? The valuations have come off quite drastically from the highs. My understanding is you've gone overweight gold and tactical overweight on silver for at least the short term from a tactical standpoint. What's driving that call?
So silver is more of a trading call.
Right.
There, we believe ups and downs will continue to emerge because there is supply emerging from mines in Latin America. The demand is also getting replaced by other assets as silver becomes expensive. So it's a tactical trading call, will continue to add or deduct depending upon price movement. On gold, our view remains positive. In one simple line, as long as central banks of the world are buying gold, will continue to be positive on gold. If they decide to sell gold, will immediately turn negative. And if they don't do anything, then will be neutral. Right now, gold prices have corrected from high to a fairly lower level, partly driven by rising US interest rates and partly driven by some liquidation by some of the central banks in the last quarter. This quarter, it is expected that central bank buying has resumed. So we are focusing upon central bank activity, and we still believe there is still some room for central banks to increase their allocation to gold, and it is essentially front running for the central bank activity.
And you see the central banks looking at gold at this point in time, given the fact there is an inflation risk which is also coming in because of geopolitics?
See, by and large, Sajid, by inflation risk is positive for gold. It is known as a store of value, and over longer period of time, it has given return which is in line with the inflation. The worry is on the interest rate side. If interest rates are higher, then the cost of investing into gold becomes difficult. For central banks, the choice is also diversification. After Russia's FX reserves were frozen by Western world, every central bank around the world is looking to diversify their reserves, and gold is one commodity which can be traded. So we still believe central banks around the world will continue to add gold to their reserves for diversification, and that will support gold prices in the days to come.
For an investor, what is a safer space to be in sectorally right now?
Ayesha, safer definition will vary from one investor to another investor. Our recommendation will be when you are investing in equity, be ready for downside, be ready for volatility. But at this point of time, from market outperformance point of view, healthcare and hospitality looks one sector where there is fair amount of domestic demand. And because of rising geopolitical tension, that domestic sector is likely to continue to do well in the days to come. The second sector we are looking at positively is banking and financial services. The FPI selling resulted into historically low valuation for banks. Profit growth this quarter is looking fine. NPA pressure is absent. Overall, we think as FPIs turn seller to buyer, there is a chance that they will be looking to invest in BFSI. So selective BFSI space looks attractive from a market outperformance point of view. The third sector where we are more bullish is consumer discretionary. Clearly, there is a change in the consumption pattern. Some time back, we had come out with a research report where we said that in 2022, Apple's iPhone sales were half of Hindustan Lever's volume. And today, 2026, they are almost double of that. So people are shifting their consumption pattern. They are moving from staples to discretionary item. And hence within discretionary item, you could have opportunity.
Nilesh, trying to understand, one of the verticals you highlighted was financials, and within financials as well, lenders is what I believe you're alluding to. Would you stick with the large cap, the conventional ones, or would you go slightly down the curve because the growth there will be really quick given the kind of asset quality stabilization that's playing out? Would you play that, or would you prefer the larger ones?
Absolutely, you hit the nail. The mid-cap banking and financial services firms are able to show faster growth. They are also nimble in adopting technology. So our portfolio consists across large, mid, and small in the financial space. We believe even NBFCs provide opportunity provided they are focused on one segment rather than too much diversified.
The other piece, sir, that you spoke about was consumption as a theme. And e-commerce is something that also you seem to be liking at this point. But, knowing you as an investor, how should one look at e-commerce from a value investing standpoint? If you can give us your perspective.
So the traditional way of looking at value will not apply in e-commerce space. Many companies are loss making over there. Many companies are making much lower profit and hence trade at a much higher valuation. The traditional value investing will not work over there. But what we have to look at is what is the potential cash flow over a period of time through this relationship. E-commerce, in some sense, is a branded player. They have to build brand and customer connectivity by spending money upfront. And then over a period of time, that is monetized. We have a model where we try to evaluate what is the market size, how much share our company can get, and what kind of revenue they can generate from the customer. And as economies of scale come back, what kind of profit they can make over a period of time. So in some sense, it is net present value of cash flow. And every quarter when numbers come, you make adjustments over there, whether NPV is increasing or decreasing, and then take your decision. So I will say quick commerce is not necessarily the traditional value investing play, but here you have customers, you have brand, you have connectivity and monetization opportunity.
Nilesh, we've spoken about all the themes that you're liking, but equally important to investing is what do you not touch at a point like this? So what would you not touch even with a barge pole? Can you give us a sense?
So any company where we believe minority shareholders invests interest can be taken for granted, we have by and large stayed away. The sectorally, at a price, everything is buy and everything is sell. So valuation does become a bother while going into a sector or not. And governance becomes bother while going into corporate or not. Of course, we keep our eyes and ears open, but valuation and governance, these are the two drivers for us to avoid a particular sector or a stock.
Sir, which is not looking good. Just top down. Of course, bottom up, there could be stories there as well, but broadly.
So consumer staple valuation looks ahead of their prices. Some of the IT companies we believe are slow in adopting to AI wave, and they will not be able to generate as much growth as is expected. Some of the NBFCs which are too diversified, they are not focused on one segment and hence does not get economies of scale. Some of the construction companies where we believe the return on equity is not justifying, their working capital is bloated and hence ROEs are coming down. And the prices do not reflect that deterioration. Essentially, these are some of the top-down approaches on various sectors.
Nilesh, it's been a great discussion that we had. But before we leave you, there were some adverse comments that came in from the Supreme Court yesterday. Do you have any comments on them?
We'll go through the judgment and revert back, but we obviously have to adhere to the judgment.
Thank you, Nilesh, for that And thank you for joining us and giving your perspective on the market.
Thank you.
We'll step into a break and come back with more.